Hi, welcome back to my channel. It is September 16th, and I'm just going to give you a quick update on the stock market and what is kind of happening with the market and with the economy right now. It's been a while since I did a video. My outlook on the market is still the same. I'm still remain bearish on this market, as the market is in a bear market. And I was just looking at some of the pre-market prices coming in on these stocks, and there's once again it's selling off. We're looking at a few of the big companies that are kind of holding this market and keeping it from collapsing right now, but eventually it will go. The dam will break and these stocks will collapse. I still believe the S&P 500 will fall no less than 50%. My buy-in point now for the S&P 500 is going to be between 23 and 2,500 on the index. I believe it will hit that easily once this market comes down. I believe we're going to hit our COVID lows, March 2020. We're going to hit those lows and probably maybe even fall below those lows. You have to remember they printed and stimulated $10 trillion from March of 2020 until just up until last year. They printed $10 trillion, and they got to get that money back out of the system because it inflated our economy. Inflation's out of control. They say it's only around 9%. I believe it's more like 20% or higher. So they got to get this, and the Fed's committed to fighting this inflation, so they're going to keep raising these interest rates. Interest rates are going to probably be raised at least 0.75 of a basis point, maybe a whole percent by the time it's said and done this month. And with the stocks right now, the stocks are falling because, here it is earnings season. Sales have slowed. You take Amazon. Amazon is down, I can't remember off the top of my head. I don't have a thing in front of me, but 40%, 30 to 40%, whatever. It's down from its all-time highs. They did the stock split, did nothing for it. Now, I want to remind you of something. When Amazon was trading at $3,600 per share, this is before the split, they were trading at $3,600, and their PE was like 45. Well, guess what? That stock has fallen. I think it's trading at like $230, or no, it's like $127, I think, per share today, and it's still falling. And that's so they did a 20-for-1 split. It's trading at $127. The PE on Amazon now is 113. 113. Amazon could collapse another 70%, 60 to 70% down or more till you get to it's crazy. They're making absolutely no money, and people are getting worried now. They're seeing these stocks the thing is, okay, how it works with this market. When these big tech companies, they were able to borrow money for the last 10 years or so with very little interest. I mean, not even 1%. 0.5% on the money they were borrowing, the hundreds of millions, and they were taking that money and boosting their stock price. They were making their earnings look better than what they were because they were doing things with the money, shuffling it around inside their company. But that's disappeared now. They can't borrow that money on the cheap anymore, and the prices are coming down. Now all of a sudden the tide's going out. You see who's naked now. Look at Tesla. Tesla's PE is right around 110, maybe a little bit below that, but it's crazy what you're seeing. And the people are paying these ridiculous prices. Tesla could crash, another 70, 80% or more. You already know from my previous videos how I believe Tesla will be, well, when it was trading at $1,200 a share before their last split. And these splits have done nothing. They're a gimmick because they know their stocks, these companies are going to crash big time. They know their stocks are going to crash on these companies, so they pull out these stock splits. Google did it. They're all doing it. It's just a trickery to make it seem like the stock is cheaper to get people to buy in. No, that's not going to save you. It does absolutely. The stock is not cheaper. It's still the same percentage. Everything's still the same. They just diluted and made more shares. It does absolutely nothing. It means nothing. So, anyways, you have these companies that are holding up the market. You have Apple, you have Microsoft, Amazon, and Tesla, and Google. These companies are holding the big crash back right now, but the dam is getting ready to break. And when it does, it's going to get ugly here, and these stocks are going to collapse. They are going to utterly collapse. Look, Facebook is not coming back. None of these companies that hit their highs back between last November and January of this year, they have not come back. They've tried to have bounces. People have piled back in only to have them resold again, and they come down below the lower lows. You're getting lower lows, and we're going to get a lower low on both the NASDAQ and the S&P 500, I believe, within this month. We're going to test these lows that we had back in June, and we're going to fall below those. And a lot of these companies, you're not going to go back to these highs. Imagine you had inherited some money last year, $500,000, $1 million or whatever, and you listen to Dave Ramsey and some of these other people and say, oh, just put it in the market. Just lump sum it in the market. I want to remind you that if you had lump summed a bunch of money back between November and January, and even up until now, if you've lump sum a huge amount of money in the stock market, I think you're not going to see those highs. You're not going to probably see where we're at right now. We may be where we're at right now in 10 years from now, or lower. All right, and I want to remind you, in 2000, had you put a lump sum of money anywhere in the year 2000, you'd be in trouble. You wouldn't have gotten back to those levels until 2014 and 2015 on the NASDAQ. So if you'd have bought the NASDAQ, the QQQ ETF or whatever back in 2000, anytime during that period of 2000 and the height of the bubble, it would have taken you between 2014 and 2015 for you to get back to even. So that's a 14 or 15 year span. That's fine if you're young. That's fine if you're a young investor, but if you're an older person right now, you don't want to lump sum into this stock market. And the people buying these dips are going to get hammered in these upcoming months and the next couple years as this market is going down. We're going to get, the Fed is not going to stimulate and print any more money. That is over now. It's done. Now they have to tighten. Now they have to raise the interest rates. Now we go into the massive recession, and it's going to get ugly here. So I just want you all to be prepared. I can't give financial advice on what you're doing with your money, but I know one thing: I'm staying in cash a while, and I'm not even thinking about buying back into any stocks until I see the S&P 500 fall below 3,000 before I even start buying back in. And I am staying away from the NASDAQ. I sold my QQQ ETFs in November of 2021. I got out at $405 a share. We may never see that high again, and I am so glad. Every day I wake up, I am so glad I dumped those shares back in November. I am so glad. And when I see the condition of the market, what the Fed is doing, what our government is doing, it gives me more confidence to know I made the right choice by dumping my stocks when I did, by dumping those ETFs. So with the stocks, with most of these stocks remaining overvalued right now, they're still way overvalued. Everything is. There is no deals in the market. Look at Intel. Intel is a great company. They are still falling. They are still falling. I even thought maybe a few months ago, back in June, when they were around $39, $40. And today they're like at $29 a share, Intel. I thought at $39 and $40, well, Intel may be a buy by now. Their PE ratio was seven back then, 7. But see, their earnings came out and it just crushed their PE. The stock dropped $10 per share since then, and the PE is still around the same. So these PEs, you look at those PEs back in the bubble and everybody thought, well, Apple's great at a 25. But what if Apple's earnings come out this next time, or in these next 2 quarters Apple's earnings come out, and you find out that they didn't make any money, they're in the red, and all of a sudden their PE jumps to 50 or 100, then you're going to see Apple collapse. And I believe Apple's going to come down no less than 50%. I know a lot of you are watching this video thinking I'm crazy, but you're going to see that these companies were all overinflated, over bloated, stimulated money grossly, made their earnings look better than what they were. The market is falling, and the rich are gonna take their money out of here. The super wealthy know how to play this game, where the average retail investor just blindly buys ETFs and index funds, thinking the market goes up forever. We may be in a time where there's a reversal of that, where the next 10 to 15 years, maybe even 20 years, there's not really big gains in the market at all. That those days are over. The stimulating's over, the money printing is over, the Fed's no longer going to do that. They are committed to raising interest rates and getting control over this inflation. Like I said, I believe inflation's more around 20%. I believe they're lying when they say the inflation's, a little over 8%. They're lying. Just look at everything you're buying. Look at fuel. Look at your gas when you go put gas in your car. Look at the food at the grocery store. Look at everything you're buying. Look at your insurance that went up. Look at the price of housing. Housing is another thing. That bubble's getting ready to break. Houses are going to come down 50% in the next 2 years. The housing market will crash. It will come down 50% or more. This is a bubble that's maybe even bigger than the stock market bubble. Is this housing that is going on? And you're going to run out of buyers and people that can qualify for a loan, because the interest rate's going up. They'll have to raise interest rates on houses as the Fed, on mortgages, as the Fed raises the interest rate for the banks. So you're going to have problems with people getting loans, and the whole thing is just a mess and a debacle right now. I'm waiting it out on the sidelines. My target price on the S&P 500 is going to be 2,300 or lower, probably before the end of next year, 2023. We may even see a drop below 3,000 on the S&P 500 this year. By the fourth quarter earnings, we may see a drop below 3,000. That is very possible as I look at this. But anyways, I hope you enjoyed this video. And please like and subscribe, and I will catch you on the next one. You all have a great weekend.